Is it a bear flag that's going to lead to further downside, or is it a legitimate bounce that's going to see follow through? There's four main things that we're going to be looking at here. I'm going to go over what they are a little bit, and then we're going to look at them on charts and go over it a little bit more in depth. So the number one most important thing that I'm watching on a dump, and I'm saying to myself, is this bounce for real, is the volume and the exponential moving averages. So the volume is the most important in my opinion. If we see a bounce and we have decreasing bull volume on the bounce attempt, that is red flag number one that we're looking at a potential bear flag. And that would mean that we're more likely to see a weak bounce, cool off the RSI levels without seeing much price movement, and then see further movement to the downside. So just real quick in summary, a bear flag is when you have an all-out dump and then a weak bounce attempt in a parallel channel facing to the upwards in a slight angle, which we will look at some examples, but it is the volume. If you have increasing bull volume on the way up, you know that that bounce is more sustainable and there's more likely to be more follow through. Another thing you're looking at is the exponential moving averages. The 12 and the 26 period are exponential moving averages that I had never used before cryptocurrency before. I traded stocks 7 years without them. And then I started watching, it's the default settings. It was the default settings on GDAX. When a lot of people were using GDAX, that's what everybody was looking at. So I started looking at it because I was forced to, and noticed that it was being a really good guide for support and resistances on the longer term timeframes, and really on the shorter term timeframes, it's proven to be a good one as well. This is a great gauge to be watching, and essentially a lot of times I'll say to myself, is the exponential moving averages, are they still resistance? And if the answer is yes, then it's a potential bear flag. So if we're seeing a bounce attempt on the 4 hour and the exponential resistances are approaching, yes, it is still a potential for a bear flag. That's a general rule of thumb. Obviously, it's going to vary greatly on the individual setup and the individual bounce, but those exponential moving averages are a great guide. And it's also a target that bears have been using to make bearish entries while we've been in this downtrend in this market. So volume and exponential moving averages, the most important if I'm gauging if it's a real bounce or not. Next, I want to zoom in. When you zoom into shorter term timeframes, you get more details about the setup and what is occurring. So the smaller term timeframes can give you a trend. So if I'm watching for an oversold bounce on the 4 hour time frame, I can zoom into the 15-minute chart and see our clear higher low, higher high pattern that shows that bounce. But if I zoom out on the 4 hour time frame and see that it's a relatively weak bounce compared to the size of the dump that we've seen, and it looks like the bulls are running out of momentum, we have declining bull volume, then I know, okay, watch this shorter term uptrend, because if the 15-minute uptrend is lost, that means we are more likely to see that 4 hour bear flag confirm. Two other things that I watch. Severity of the dump. Not all dumps are created equal. Some dumps have these bear flags on the way down. When that is the case, the RSI levels can get much more extreme. When we dump straight down in an elevator, not stair stepping, that's when the V-shaped bounces are more likely to occur. But again, it depends on the setup and it depends on the market environment. We've had multiple market cycles in the past year and a half, essentially, where the first pullback we saw from all-time highs, bulls were very aggressively buying those dips, and we saw tons of V-shaped recoveries, and it was very easy to make money in oversold bounces. We then entered a market cycle that was full of bear flags, and those bear flags were fake outs, and those traders that tried to play the same plays on the oversold bounces that work so well and trade these bear flags in the same way, they gave back a lot of profit. So you have to recognize the shift and where the market is as well. If it's a very bullish market and we've been in a strong uptrend and we start to see dumps, the bulls are going to be more aggressive buying those dips, and you're more likely going to see V-shaped recoveries than if we've been in a sustained downtrend for a while. The bulls are losing hope and momentum, and we get those bear flags and bearish continuation. So overall market psychology, I didn't write that down here, but where we stand in the market is important as well. Compared to others, sector leader, obviously. If I'm looking for an oversold bounce on Ethereum, I want to know what Bitcoin's going to be doing. And it's the same thing if I'm trading stocks. The S&P 500 is my Bitcoin in terms of my gauge of the leader. So for Bitcoin, if I see some initial red flags, if I see Ethereum bouncing fine and everything's going according to plan, and then I see on Bitcoin decreasing bull volume, loss of the 15-minute higher low pattern, that's a red flag to me. Even if I don't see that showing up on my chart just yet, I know that it's more likely to do so because the sector leader is not getting that follow through. So these are the four things that we're going to be looking at. Again, let's just go back over them. Volume and the exponential moving averages are the first thing that I'm looking at. I then zoom in for more details to see what the trend looks like. The severity of the dump, is it a straight shot to the downside, or are the bears getting a breather, so to speak? And I imagine visually, literally just a bear running or pushing the bulls. Let's imagine just a tug of war match. and the bears are pushing the bulls down. If they're doing it in a straight shot for as long and as hard as they can, they're going to be a lot more tired, and the bulls are going to get a solid bounce than if they're able to take little breaks. And a bear flag is essentially a break. It's allowing things to cool off before the bears get ready to take another leg down. And those moves can be more sustained to the downside, more extreme RSI levels, because they get those little breathers. And last, comparing to others, we want to look to the sector leaders. We want to look to what the market environment is like. Are we in an uptrend on the daily and the weekly time frame, and these bounces are going to be more aggressively bought? Are we in a sustained downtrend, and a bear flag is going to be more likely? So prevailing trend definitely has an impact as well. Let's now look at some charts and some specific examples. So here's a chart on Bitcoin. This is from August 2018, and what I want to highlight here on the 4-hour time frame, again, these exponential moving averages, the 12 and the 26 period. Look at how great of a guide they were, and every single time we hit one of these exponential moving averages, bears could make a re-entry if they exited on the leg down, or just affirm their hold and not sell as long as we keep rejecting from these exponential moving averages. And you can see this kept up for multiple days. We were at July 31st, and this went all the way to August 11th. So we're talking almost a week and a half of straight rejection after rejection after rejection. And then when we finally started getting over these exponential moving averages, that's when the bulls shifted momentum. So again, just as a guide, these exponential moving averages are great. And also the volume. We looked in here. Do we see any increases in volume? You can't just look at only the bar. So if I look at this bar and I say, well, that's a big bull volume spike. Well, a lot of that was the bears as well. That lower wick means, yes, the bulls did buy the dip, but the bears saw a decent amount of volume to push that price all the way down there. And so while we did see a recovery, I would not call that increasing bull volume. The candlestick and knowing what was going on during that candlestick, the shape of it, it gives you a little bit more of a clue. If that were just a straight up green candlestick with no lower wick, we can say, all right, that's mostly bull volume and attribute that volume to the bulls. But we have to say it's half and half because of that dump and then bounce. So clearly big spikes in bear volume, lack of any increasing bull volume, and that was what kept the downtrend alive. And on these specific instances, you could zoom into the shorter term time frames and watch the loss of higher lows to be an indication that the odds of that bear flag following through are going to be a lot more likely. Now we're going to look at Ethereum. This is on the hourly time frame. So this is in September just recently now, and it shows a shift in momentum. So we're looking on the hourly time frame. I'm looking at the clear exponential resistance. We see a little bit of increasing bull volume. And then, of course, I'm looking at other patterns as well where there's a very clear hourly equilibrium with our low, high of the bounce, higher low, lower high, higher low, and then the bull volume shows up. So sometimes we get a trend change and bulls showing up with the bounce for real, not just in a V-shaped recovery, but in a sideways trading pattern and then a bull move. And if you remember Bitcoin in April, we saw a daily equilibrium that lasted either 9 or 11 days, and then a huge bull volume spike that squoze a bunch of shorts and cause them to cover as well. So that was the kind of a bounce for real that shows a tightening range. Imagine a rubber band getting stretched really tight, and then it finally snaps in a direction. And when it favors the bulls, obviously we get that bounce follow through. So V-shaped recovery, sideways equilibrium, and then bull break, or bear flag is essentially what we're looking for when we see a clear bounce attempt. So what made us say this was not a bear flag? This entire time, I would be saying caution of a bear flag absolutely is looking like that setup. If we lose the hourly higher low pattern here on this bounce attempt, the odds of a bear flag increase significantly. We did not see that happen. The bulls saved it. And as soon as we broke the high of the bounce, the bull volume started coming in. And that was the signal that this is not a bear flag. So getting over exponential resistance on increasing bull volume and breaking to a higher high is certainly a signal that the bounce is for real. And something that looks like a bear flag can quickly turn that around if the bull volume shows up. You're never going to see a bear flag like this in a downtrend, just see a weak bull volume move to change this momentum. It's always going to be accompanied with a bull volume spike, so you know it's for real because that volume is our prove it indicator. So Bitcoin here on the hourly time frame. Here's another example where the bounce, you look for number one for a volume climax after a dump often can signal the bottom. Then we see the size of the bounce here. And one of the patterns you'll often see on these V-shaped recoveries is the inverse head and shoulders pattern. So the inverse head and shoulders pattern is when you have a clear downtrend of lower highs and lower lows, and then the bounce is significant enough that you anticipate a higher low is going to form. So between the low of 9,000 and the bounce up to 10,400, that's a very significant bounce, and we can anticipate that a higher low is going to form after that because of the size of that bounce and the amount of space that the bulls have to work with before we would drop to a lower low. Also, the declining bear volume and then increasing bull volume. That shows a clear trend change. It's an inverse head and shoulders pattern. The clear bull break is when we get the higher low here and then break the what is called the neckline of 10,500. And then from there, the bulls saw a decent amount of follow through all the way up towards 13,000. So again, the severity of the dump increases the odds that it's going to be a V-shaped recovery, but you have to see the bull volume show up because you can have a severe dump and a weak bull bounce giving you that bear flag that just leads to another leg to the downside. The other kind of bounce is a V-shaped recovery that is significant enough that we can anticipate a higher low and higher high confirming the trend change will occur. And then the third scenario is that sideways equilibrium that a bull break gives the follow through for. So those are some different examples on how to gauge whether this is bounces for real. Again, prove it indicator, volume, number one. Is the bounce for real or is it another bear flag? And always using stop losses when you think the bounce is for real and protecting against the possibility that it is a bear flag obviously is the best protection that you can have. And using those shorter term time frames to watch the little shorter term uptrend that's eventually leading to a longer term continuation of the downtrend is a good guide for where to put your stop levels when you zoom in to get those more details.